Hi, this is Jamsi. I'm a finance professor, and welcome to part 3 of the overview of business analysis and valuation using financial statements. So, in the last video, we started talking about the financial statement as a means of communication for the company to its investors and how certain factors affect the quality of information that is being reported to the investors. In the last video, we also discussed Sarbanes-Oxley Act, and the Dodd-Frank Wall Act of 2010. Thus, from there, we move forward for the third part of this video to the financial statements to business analysis. Because managers have insider knowledge, and this insider knowledge is a source of both value and distortion in accounting data, it is difficult for outside users of financial statements to separate information from distortion and noise. And not being able to undo accounting distortions completely, investors discount a firm's performance. So, in doing so, they may make a probabilistic assessment of the extent to which a firm's reported number reflects its economic performance. As a result, investors frequently have an imprecise assessment of a firm's performance. Financial information and information intermediaries, as discussed in the last video, can add value by improving investors' understanding of a firm's current performance and its future prospects. Thus, we stop talking about the intricacies of the financial statement and get right along to business analysis. So, in the past, we have shown you a diagram where the different elements that affect the financial statement that is being shared to the client. So we saw elements such as the business environment, the accounting environment, the choice of the accounting standards, and others. Here, in this particular section of this module, we take a look at the financial statements and other analysis as tools that is vital to develop a business strategy. So it is through the use of the financial statements and other information that the firm is able to generate performance expectations through industry analysis and competitive strategy analysis. Now, in business strategy analysis, we look at three different things. First, we look at the accounting of the business. Therefore, we evaluate the accounting quality by assessing accounting policies and estimates. Second, we also look at the financial analysis. How does it differ from accounting analysis? Financial analysis revolves around the evaluation of performance using ratios and cash flow analysis using the data that is found in the financial statements. So therefore, we can infer that financial analysis can be, or the byproduct of financial analysis can be affected by the quality of accounting policies, procedures, and estimates. Also, a third facet of business strategy analysis is prospective analysis, meaning we start doing forecasts and value our business based on the information that we have for a particular business. And we are not just limited to financial statements, credit reports, securities reports, M&A reports, but other industry data and other information that is available to a company. So, business analysis using the financial statements begin with the identification of key profit drivers and business risk. So, step one, you need to understand the business environment and how the business makes money. Second, you need to assess the company's profit potential at a qualitative level. All right. And the third one is to analyze the strategy and the industry of a particular business to create a sustainable competitive advantage. So this type of analysis, or this qualitative analysis, is an essential first step because it enables the analyst to better frame the subsequent accounting and financial analysis. For instance, identifying the key success factors and key business risks allows for the identification of key accounting policies and the assessment of a firm's competitive strategies and facilities, and evaluating whether the current profitability is sustainable will help the business formulate a strategy as to how they can move forward. Finally, business analysis enables the analyst to make sound assumptions in forecasting a firm's future performance. After you've framed the business, or after you try to understand how the business works and assess the different risks that are present internally and externally for the business, you proceed with the accounting analysis. Now, what are the steps precisely in accounting analysis? Step number 1, evaluate the degree to which the firm's accounting captures its underlying business economics. So you need to make sure that the accounting is really reflective of how the business works. Second, evaluate the appropriateness of the firm's accounting policies and estimates. Is it okay? Could it be better? Or is it actually wrong for the company? Or are the numbers that you see inappropriate, as is the case for the firm? Third, you need to start to detect any distortion in the numbers reported in the financial statements. And lastly, you need to undo the distortions by recasting the financial statements. Now, after analyzing the accounting that is the basis for the financial reports, you need now to look at it from the financial perspective. So given that you know how the business works and how the accounting is actually done, step 3 involves looking at the numbers based on what you already know from the previous steps. Financial analysis involves the evaluation of current and past performance of a firm and assess sustainability. It allows the firm a systematic and efficient analysis of their financial data and gives us insights as to what potential business issues there might be just by looking at the financial report. Usually, the common ways in which to analyze the finances of a business is through ratio analysis and cash flow analysis, which will be discussed in the next few chapters. Lastly, we have step 4. Step 4 involves forecasting the firm's future using financial statements forecasting and valuation. So basically, you try to get yourself updated with how the firm works. Second, you familiarize yourself with how the accounting is done and you get to clean up the financial data accordingly. Now, after cleaning up the financial data, start looking into what these numbers might mean for the business. And lastly, based on your findings, you need to forecast the firm's trajectory. So this is the basic process of business analysis. In order for us to be able to begin with our analysis of the business, we need to go back to certain things, which is strategic management, because we need to take a look at the competitive, corporate, and industry analysis in business. So let's familiarize ourselves first with the two types of companies. We have the private companies and the public companies. The private companies are also called the privately held corporations. And these particular companies are owned by its founders, the management, or a group of private investors. The public companies, on the other hand, are also called publicly traded companies, and it is a company that sold all or a portion of itself to the public via an initial public offering in the stock market. Lastly, public companies will be open to claims from shareholders to a portion of its assets and profits. So when we take a look at a business strategy, we need to learn, hey, what's the deal? What's the setup here? So once we know the type of company that we're analyzing, then we start to take a look at certain things. We start asking, what's a firm's competitive strategy? A firm's competitive strategy concerns how to compete in the business areas in which the firm operates. So basically, it's like having a game plan. If you are in a basketball game, it means that how are you going to compete with the other team in that particular instance, in that particular situation. It focuses on how a firm intends to create and maintain a competitive advantage with respect to its competitors. Now, what does this mean? Holding a competitive advantage over competitors mean to be more profitable than competitors over the long term. A firm's competitive strategy within a given business area is examined by looking at two factors: the creation of the competitive advantage and the protection of the competitive advantage. So, meaning to be sustainable, you have to be able to, as a business, establish a competitive advantage in a certain facet of your business. Not only should you be able to establish that competitive advantage, but you should be able to protect it and keep that advantage in order to be more profitable over the long term. So, what's the most common competitive strategies? There are quite a few. To take a look at it, we have the following: cost leadership, differentiation. We also have the different elements for each and how they are able to contribute to the competitive advantage of a business. So let's go through them a little bit more. Cost leadership, which means a business will supply the same product or service just like his or her competitors have at a lower cost. So what does this mean? A business that is considered the cost leader in its industry achieves economies of scale and scope. It means that they are able to produce more products at a lesser price and are able to cover a larger portion of the market. Being a cost leader also equates to the efficient production and simpler product design. This allows for lower costs simply because you don't have to put a lot of bells and whistles in your products. Being a cost leader also means that you have lower input costs, meaning you may have a little bit lesser direct materials cost or direct labor cost. And it means that you're also operating a supply chain that is sophisticated but is comparatively cheaper to operate and maintain compared to the competition out there. When you're a cost leader, there is little research and development or brand advertising necessary. And there needs to be a tight cost control system so that you will be able to maintain that leadership over the competition. On the other hand, we have differentiation. Now, what does differentiation mean? Or what is differentiation as a competitive strategy? Differentiation supply a unique product or service at a lower cost, lower than the price premium that customers will pay. So in cost leadership, you supply a generic product or service at a lower cost. In differentiation, you supply a different product from the product being sold by your competitors and offer it at a lower cost, and usually it's going to be lower than the price premium that the customers are willing to pay. If you employ the differentiation strategy, you can expect superior product quality, variety, superior customer service, flexible delivery, and there is a significant investment in brand image and research and development. In differentiation, you don't really need to enforce a tight cost control system. Rather, the control is put in place to ensure that there is constant creativity and innovation, because these two things is what's going to keep your business different from your competitors. Also, we have how these two actually contribute to competitive advantage. So how do these two strategies lead to competitive advantage? Because there is now going to be a match between a firm's core competencies and key success factors to execute a strategy. There is also a match between a firm's value chain and activities required to execute a strategy. All right? So, a firm's profitability is actually influenced not only by its industry structure, but also by the decisions it makes. Just like I said, competing in business is like playing a basketball game. You should always have a plan. These two strategies, cost leadership and differentiation, have broadly been seen as mutually exclusive. While firms straddle and combine the two strategies, however, this results in a company being stuck in the middle. And as a result of combining both strategies together, the business should be able to expect low profitability in this regard. Right. How do you achieve competitive advantage? To evaluate whether a firm is likely to achieve its intended competitive advantage, the business analyst should ask the following questions. First, what is the customer need that the company is focusing on? Of course, in order for you to find out how you can get ahead, you need to get hold of the problem first. What is the need that the company is focusing on? Second, how does the company distinguish its customer value proposition from the alternative propositions available to the customers from its competitors? For short, you need to ask, what can I offer that my competitors cannot? Third, does the firm currently have the key capabilities and processes to deliver this value proposition? Lastly, do I have the resources to back up my claims or to back up my offer? So the choice of competitive strategy does not automatically lead to competitive advantage. You have to be smart enough and understand the things that will give you the competitive advantage. Thus, the examination should start from within. Here's more questions that the analyst would ask to evaluate and sustain the competitive advantage of a company. You need to ask, are there any barriers to imitation in this company's strategy? If so, what are these barriers and how long are they likely to last? So, in the business game, you should be able to keep that competitive edge over your rivals, if I may say so. And in order to do that, your business must be inimitable. For short, hindi ka dapat magagaya ng basta-basta. And if you can keep being unique, try and get a hold of it, try and hold on to it as much as you can. Second, are there any changes that potentially affect this company's industry and its strategic position in that industry? What are they? In what way are these changes likely to lead to changes in the competitive dynamics in this industry? So now you're starting to ask about the risk that may affect your future in a certain industry. How is it going to affect you as a business doing or operating in that industry, and how do these changes affect the current dynamics in the industry? Third, what actions, if any, can this company take to address these changes and renew its competitive advantage? How likely is it rather that the company will be able to renew itself successfully? So what does this mean? What can you do to address and roll with the punches? Para kang artista. You should be able to reinvent yourself to stay relevant. That is how you keep competitive advantage. Now, what is competitive strategy analysis? It is a strategy that involves major competitors to gain insight on their products, sales, and marketing tactics. So, for short, you check out your competitors because it can help you learn the ins and outs of how your competitor works and thinks. Therefore, it gives you the potential opportunities where the business or where the competitor can be outperformed, and in the same manner where we can be outperformed by our competitors. Second, enables the business to stay on top of the industry trends because you always keep tabs of your rivals and ensure that your products will consistently meet and exceed industry standard. Third, competitive strategy analysis provides a firm with a benchmark against which the firm can measure growth. All right. So, as an example, in this slide, I have included a case on TJ Maxx and Nordstrom to better appreciate the concept of competitive advantage and competitive strategy analysis. I invite you to take a look at these cases, and I will be happy to share this material. So, after talking about creating and keeping competitive strategy, we move forward to the different types of corporate structure. So, as per corporatefinanceinstitute.com, there are four types of organizational business structures that is being used around the world. So, we have functional structure, the matrix structure, the divisional structure, and the hybrid structure. So let's take a look and compare each of these one by one. The functional structure involves the employees being grouped into departments based on their skill sets, tasks, and accountabilities for efficient decision making. So, for short, your functional structure is your classic biz dev department, accounting department, marketing department, IT department, general services department, and what not. The divisional structure, on the other hand, organizes business activities into specific market, product, service, or customer group to create work teams that can produce similar products that cater to needs of individual groups. So, in the divisional structure, this is where you will find groupings such as the groupings per geographical area. So such as the EMA team, or the Middle East, the MEA team rather, the Middle East Asia team, or the North America team, the South America team. Or you could also group your business according to the types of products that you have. You may group your business as either the consumer goods division, the electronics division, and other things. Now, the matrix structure is a combination of functional and divisional structures. And this particular structure in a corporation allows for a decentralized decision-making, greater autonomy, and greater interdepartmental interaction, thus giving us or giving the company greater productivity and innovation. Now, how does the matrix structure look? The matrix structure would look like this. It's a literal matrix where the CEO would have at the top level the different functions, but for each of the functions, there is a corresponding director. So for short, if it's for a particular product, or if you're grouping in terms of divisions, there is a director of marketing for product A, product B, product C, and product D. The same thing for HR, for product A, product B, product C, and product D, and so on. So in this case, there are 4 directors for marketing, HR, and finance, 1 for each division. So that is how the matrix structure works. Next, we have the hybrid structure. The hybrid structure also combines the functional and divisional structures, and it combines departments that can either be functional or divisional, thus allowing the utilization of knowledge and resources in each department while maintaining product specialization in each division. So how does the hybrid structure look like? The hybrid structure look like this. So as you can see from the chart, the hybrid structure combines both. So if there is only a need for 1 marketing, 1 HR, and 1 finance team, then for these particular positions, the company applies the functional structure. But let's say, for example, you have multiple products and you want to ensure that each of the products are taken care of, and there will be no product left behind by the biz dev team. So that's when the division comes in. So you create divisions for each of your products while the rest of the administrative section in the company follows the functional structure. In the divisional structure, there is a director for product A, product B, and product C. Each will have their own marketing teams and their biz dev teams if needed. All right. So now that we're familiarized with the types of corporate structure, let's go to the key components of corporate strategy. So we've all gone through this in our strategic management course. So it's important that the company is able to establish a vision, objectives, and will be able to allocate resources effectively. So visioning involves setting the high-level direction of the organization, setting the mission, vision, and corporate values. On the other hand, objectives involve setting high-level goals for the company spanning 3 to 5 years in length using the vision of the company. These corporate objectives are measurable goals which an organization plans to achieve within a given period of time. Next, we have resource allocation, which is concerned with the effective allocation of human and capital resources in the context of the stated objectives and the company's vision. Lastly, we have the prioritization or the presence of strategic trade-offs, because it won't always be possible to take advantage of all feasible opportunities given the risks in the business's internal and external environment. So therefore, the company must be able to balance strategic trade-offs with risks and returns and ensure that the desired level of risk management and return generation are being pursued. So it's like that in life. You can't do a million things at once. You always start with what's the most urgent. You delegate the tasks that you can, and you do at a later time the things that could wait. So the same is true for businesses. You focus on the top priority. So to recap our learnings from strategic management, these are the differences between objectives, goals, and a set action strategy. And to check whether everything is aligned, the vision should be aligned with the mission. And in accordance with the mission, you define your desired outcome, which becomes your goal. And in order to achieve your goal, what is the specific target or what is your KRA? And to achieve your key result areas or the objectives that you want or you have established in order to reach that goal, you should also be able to align a set of activities that will do just that. All right. Now, with that said, we can now define what a corporate strategy is. A corporate strategy is a unique plan or framework that is long-term in nature, designed with an objective to gain competitive advantage over other market participants while delivering both client and stakeholder promise. It establishes the overall value of a business, sets strategic goals, and motivate employees to achieve them. Now, what is corporate strategy analysis? It is the evaluation of economic consequences, either positive or negative, of managing the different kinds of businesses in one corporate umbrella. Just like in competitive strategy analysis, you start asking a series of questions in order to assess the economic effects of your chosen strategy. All right. And to do this, here are some of the questions that we ask when we analyze a corporate strategy. So here's this, and here's the other typical set of questions that we ask. Lastly, in Strama, before we do anything else, we check our surroundings through industry analysis. So, what is industry analysis again? It is the assessment of the profit potential of each of the industries in which the firm is competing. And one of the ways to analyze an industry is to look at it through Michael Porter's 5 forces, as shown in the chart. So you examine the threat of new entrants, the competitive rivalry, threats of substitute, the extent of the supplier's power, and the bargaining power of investors. All right. Now, why do you think we need to do industry analysis? Industry analysis is a tool that is being used to assess the market to figure out the dynamics in the industry the business is in. It helps the analyst and the management make sense of what is going on in their industry. A potential limitation, however, of the industry analysis framework is the assumption that industries have a clear boundary, because in reality, it is not easy to demarcate or identify the boundaries of a certain industry. All right. So this ends our discussion for the overview of strategic business analysis. In the next module, we'll start talking about accounting analysis and how it's going to be done. In that regard, I hope you've learned something from me, and I'll see you in the next video. Bye!